The key thing missing was a way to make a ton of money. In the 1950s, a young physics graduate, Ed Thorpe, was doing his PhD in Los Angeles. But a few hours' drive away, Las Vegas was quickly becoming the gambling capital of the world, and Thorpe saw a way to make a fortune. He headed to Vegas and sat down at the blackjack table. Back then, the dealer only used a single deck of cards, so Thorpe could keep a mental note of all the cards that had been played as he saw them. This allowed him to work out if he had an advantage. He would bet a bigger portion of his funds when the odds were in his favor, and less when they weren't. He had invented card counting. This is a remarkable innovation considering blackjack had been around in various forms for hundreds of years. And for a while, this made him a lot of money. But the casinos got wise to his strategy, and they added more decks of cards to the game to reduce the benefit of card counting. So Thorpe took his winnings to what he called the biggest casino on Earth, the stock market. He started a hedge fund that would go on to make a 20% return every year for 20 years, the best performance ever seen at that time. And he did it by transferring the skills he honed at the blackjack table to the stock market. Thorpe pioneered a type of hedging, a way to protect against losses with balancing or compensating transactions.
Thorpe did it mathematically. He looked at the odds of winning and losing and decided that under certain conditions, you can actually tilt the odds in your favor by using certain patterns to be able to make bets.
Suppose Bob sells Alice a call option on a stock, and let's say the stock has gone up, so now it's in the money for Alice. Well, now for every additional $1 the stock price goes up, Bob will lose $1. But he can eliminate this risk by owning 1 unit of stock. Then, if the price goes up, he would lose $1 from the option, but gain that dollar back from the stock. And if the stock drops back out of the money for Alice, he sells the stock so he doesn't risk losing any money from that either. This is called dynamic hedging. It means Bob can make a profit with minimal risk from fluctuating stock prices. A hedged portfolio pi at any one time will offset the option V with some amount of stock delta.
It basically means I can sell you something without having to take the opposite side of the trade. And the way to think about it is I have synthetically manufactured an option for you. I've created it out of nothing by doing dynamic trading, dynamic hedging.
As we saw with Bob's example, delta, the amount of stock he has to hold, changes depending on current prices. Mathematically, it represents how much the current option price changes with a change in the stock price. But Thorpe wasn't satisfied with Bechelier's model for pricing options. I mean, for one thing, stock prices aren't entirely random. They can increase over time if the business is doing well, or fall if it isn't. Bechelier's model ignored this, so Thorpe came up with a more accurate model for pricing options, which took this drift into account.
I actually figured out what this model was back in the middle of 1967, and I decided that I would just use it for myself, and then later I kept it quiet for my own investors. The idea was to basically make a lot of money out of it for everybody.
His strategy was, if the option was going cheap, according to his model, buy it. If it was overvalued, short sell it, that is, bet against it. And that way, more often than not, he would end up on the winning side of the trade. This lasted until 1973. In that year, Fisher Black and Myron Scholes came up with an equation that changed the industry. Robert Merton independently published his own version, which was based on the mathematics of stochastic calculus, so he is also credited.
I thought I'd have the field to myself, but unfortunately, Fisher Black and Myron Scholes published the idea, and they did a better job of the model than I did because they had very tight mathematics behind their derivation.
Like Bechellier, they thought that option prices should offer a fair bet to both buyers and sellers, but their approach was totally new. They said, if it was possible to construct a risk-free portfolio of options and stocks just like Thorpe was doing with his delta hedging, then in an efficient market, a fair market, this portfolio should return nothing more than the risk-free rate, what the same money would earn if invested in the safest asset, U.S. Treasury bonds. The assumption was that if you're not taking on any additional risk, then it shouldn't be possible to receive any extra returns. To describe how stock prices change over time, Black-Scholes and Merton used an improved version of Bechelier's model, just like Thorpe. This says that at any time we expect the stock price to move randomly, plus a general trend up or down, the drift. By combining these two equations, Black-Scholes and Merton came up with the most famous equation in finance.
It relates the price of any kind of contract to any asset, stocks, bonds, you name it. The same year they published this equation, the Chicago Board Options Exchange was founded.
Why is that equation so important? Like for finance, how did that change the game?
Well, because when you solve that partial differential equation, you get an explicit formula for the price of the option as a function of a bunch of these input parameters. And for the very first time, you now have an explicit expression where you plug in the parameters and out pops this number so that people can actually use it to trade on.
This led to one of the fastest adoptions by industry of an academic idea in all of the social sciences.
Within just a couple of years, the Black-Scholes formula was adopted as the benchmark for Wall Street for trading options. The exchange-traded options market has exploded, and it's now a multi-trillion-dollar industry. The volume in this market has been doubling roughly every 5 years. So this is the financial equivalent of Moore's Law. There are other businesses that have grown just as quickly, like credit default swaps market, the OTC derivatives market, the securitized debt market. All of these are multi-trillion-dollar industries that in one form or another make use of the idea of Black-Scholes-Merton option pricing.
This opened up a whole new way to hedge against anything, and not just for hedge funds. Nowadays, pretty much every large company, governments, and even individual investors use options to hedge against their own specific risks.
Suppose you're running an airline and you're worried that an increase in oil prices would eat into your profits. Well, using the Black-Scholes-Merton equation, there's a way to accurately and efficiently hedge that risk. You price an option to buy something that tracks the price of oil, and that option will pay off if oil prices go up, and that will help compensate you for the higher cost of fuel you have to pay. So Black-Scholes-Merton can help reduce risk, but it can also provide leverage.
An ongoing battle between bullish day traders and hedge fund short sellers that have bet against the stock. GameStop shares have now risen some 700%.
Well, GameStop is a really interesting example for all sorts of reasons, but options figured prominently in that example because a small cadre of users on this Reddit sub-channel, Wall Street Bets, decided that the hedge fund managers that were shorting the stock and betting that the company would go out of business needed to be punished. And so they bought shares of GameStop stock to try to drive up the price. Turns out that buying the stock was not enough because with $1 worth of cash, you can buy $1 worth of stock. But with $1 worth of cash, you can buy options that affected many more than $1 worth of stock. Perhaps in some cases, $10 or $20 worth of stock for $1 worth of options. And so there's natural leverage embedded in these securities. And so the combination of buying both the stock and the options caused the prices to rise very quickly. And what that did was to cause these hedge fund managers to lose a lot of money quickly.
How big is this market for derivatives? How big is this whole area that kind of comes out of Black-Scholes-Merton?
There are estimates of how large derivatives markets are. And first, let's be clear what a derivative is. A derivative is a financial security whose value derives from another financial security. So an option is an example of a derivative. In general, the size of derivative markets globally is on the order of several $100 trillion.
How does that compare to the size of the underlying securities they're based on?
It's multiples of the underlying securities.
I just have to interrupt because it seems kind of crazy that you have more money riding on the things that are based on the thing than the thing itself.
That's right.
So tell me how that makes any sense.
Because what options allow you to do is to take the underlying thing and turn it into 5, 10, 20, 50 things. So these pieces of paper that we call options and derivatives, they basically allow us to create many, many different versions of the underlying asset. Versions that individuals find more palatable. because of their own risk-reward preferences.
Does this make the markets and the global economy more stable or less stable or no effect?
All three. So it turns out that during normal times, these markets are a very significant source of liquidity and therefore stability. During abnormal times, by that I mean when there are periods of market stress, all of these securities can go in one direction, typically down. And when they go down together, that creates a really big market crash. So in those circumstances, derivatives markets can exacerbate these kinds of market dislocations.
In 1997, Merton and Scholes were awarded the Nobel Prize in Economics. Black was acknowledged for his contributions, but unfortunately he had passed away just 2 years earlier.
We're going to make a lot of money in options, but now Black and Scholes have told everybody what the secret is.
With the option pricing formula now out for everyone to see, hedge funds would need to discover better ways to find market inefficiencies. Enter Jim Simons. Before Simons had any exposure to the stock market, he was a mathematician. His work on Riemann geometry was instrumental in many areas of mathematics and physics, including knot theory, quantum field theory, and quantum computing. Chern-Simons theory laid the mathematical foundation for string theory. In 1976, the American Mathematical Society presented him with the Oswald Veblen Prize in Geometry. But at the top of his academic career, Simons went looking for a new challenge. When he founded Renaissance Technologies in 1978, his strategy was to use machine learning to find patterns in the stock market. Patterns provide opportunities to make money.
The real thing was to gather a tremendous amount of data, and we had to get it by hand in the early days. We went down to the Federal Reserve and copied interest rate histories and stuff like that, because it didn't exist on computers.
His rationale was that the market is far too complex for anyone to be able to make predictions with certainty. But Simons had worked for the U.S. Institute for Defense Analysis during the Cold War, breaking Russian codes by extracting patterns from masses of data. Simons was convinced that a similar approach could beat the market. He then used his academic contacts to hire a bunch of the best scientists he could find.
What was your employment criteria then? If they knew nothing about finance, what were you looking for in them?
Someone with a PhD in physics and who'd had 5 years out and had written a few good papers and was obviously a smart guy, or in astronomy, or in mathematics, or in statistics. Someone who had done science and done it well.
It's not surprising that mathematicians and physicists are involved in this field. First of all, finance pays a lot better than being an assistant professor of mathematics. And for a number of mathematicians, the beauty of option pricing is equally compelling to anything else that they're doing in their professions.
One of these was Leonard Baum, a pioneer of hidden Markov models. Just as Einstein realized that although we can't directly observe atoms, we can infer their existence through their effect on pollen grains, hidden Markov models aim to find factors that are not directly observable, but do have an effect on what we can observe. And soon after that, Renaissance launched their now famous Medallion Fund.
Using hidden Markov models and other data-driven strategies, the Medallion Fund became the highest returning investment fund of all time.
This led Bradford Cornell of UCLA in his paper Medallion Fund, the Ultimate Counterexample, to conclude that maybe the efficient market hypothesis itself is wrong.
In 1988, I published a paper testing it for the U.S. stock market, and what I found was that the hypothesis is false. You can actually reject the hypothesis in the data, and so there are predictabilities in the stock market.
So it's possible to beat the market, is what you're saying?
It's possible to beat the market if you have the right models, the right training, the resources, the computational power, and so on and so forth. Yes.
The people who have found the patterns in the stock market, and the randomness for that matter, have often been physicists and mathematicians, but their impact has gone beyond just making them rich. By modeling market dynamics, they've provided new insight into risk and opened up whole new markets. They've determined what the accurate price of derivatives should be, and in doing so, they have helped eliminate market inefficiencies.
Ironically, if we are ever able to discover all the patterns in the stock market, knowing what they are will allow us to eliminate them. And then we will finally have a perfectly efficient market where all price movements are truly random.